Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the outside day trading strategy. The outside day trading strategy, a method that consistently defines major market turns and momentum shifts. You will discover how this specific candlestick pattern act as a reliable signal for both trending continuations and for reversals. This strategy helps countless traders refine their entries and exit points with precision. Stay until the end as we break down in real chart example and show you exactly how to spot this setup. Now, what is the outside day? The outside day forms when today's price action completely engulf in the previous day price action. Example of this is, let me look for an example and show you. When today, look at this candle, is completely engulfed in the previous day candle range. This means we can see both highs and lows of the other day before the candle. I will repeat that again. This means we see both a higher high and a lower low than the day before. Think of this as the market flexing its muscles, showing increased volatility and potential for a significant move. This is an example of an inside day candle, this particular bullish candle in this area here. The pattern consists of two essential elements that you need to watch out for. The first one is the current day must have a higher than the previous day, and the current day must have the lower low lower than the previous day. When you spot this formation, it reveals that the volatility is expanding and major players are actively participating in the market. This increased activity often precedes a substantial price movement that we can capitalize on. If you notice, after the outside day, there was a momentum that followed it. The outside day comes in two main forms that you would need to encounter. The bullish outside day, when the price closes above the open during an uptrend. This is an example of a bullish outside day. This indicates that buyers have taken control, and it signals strong buying pressure coming in. This often leads to the continuation move that can provide excellent trading opportunity. The second one we can talk about is the bearish inside day candle. Let me look for an example of the bearish inside day candle. This is an example of the bearish inside day candle, where the previous day is trading is smaller than the previous day candle. Let's assume this day candle is smaller compared to, is totally engulfed in the previous day candle. That is what it means. So this is an example of a bearish outside day candle. During a downtrend, when price shows below the open of this candle, it indicates that sellers have taken control. This pattern becomes particularly significant when accompanied by high trading volume. If we notice, as I turned on my volume indicator, there was a high volume at this particular area of the market. So this pattern is backed up by the volume indicator. We have to pay close attention to the trading volume when this pattern appears. High volume during the formation strengthens the signal reliability. A low volume outside day might not carry the same weight and lead to a false signal. How do we implement this strategy? Let's break down exactly how we can trade this pattern effectively. The key is to align your trade with the dominant market trend while using the outside day as your precise entry trigger. If you notice, we combine this with the trend of the market. Market is trending towards the downside, and in this case the market was trending towards the upside. For continuation trades, when you spot an outside day in an established trend, here is your action plan. First of all, you wait for market to show you a downtrend. You look for the outside days that close below. When we see an outside day that close below their previous opening price, the previous candle opening price, we enter a short position with stop loss above the pattern's high. We enter here, we put our stop loss above the pattern's high. Here is a very good example. Then in case of a bullish trend, we wait for the market to show an uptrend. When market shows an uptrend on the daily time frame, we enter a long position when we see an outside day candle close above its opening price. At this area, it closed above its opening price. Look at the opening price here, see the candle that closed above. We place our entry at that area. And we put our stop loss below the pattern low for protection. Your optimal entry timing comes on the next day after the outside day forms. This gives you two specific entry methods. The first entry method is you wait for price to break below or above the outside day for long or short trades. In case of a long trade, you wait for the next candle to close above the outside day formation. In case of a bearish trade, you wait for price to close below the outside day formation. This confirms the pattern direction. Then you can actually use a break entry, or you can use a retracement entry. You can enter on the pullback to the 50% level of the outside day range. This often provides a better risk to reward. You can wait for price to pull back to the outside day candle. As we can see, when price broke out of this outside day formation with this candle, price pulled back. If you can see this week, price pulled back and will enter on the pullback to the outside day trading range. When price pull back to this area, we can enter and put our stop loss just below. That's what price is trying to tell us there. The best way is actually using this pullback phrase, because this pullback helps us get a better risk to reward ratio level. Let's not forget our position sizes. Our position size should never be more than 1% of our trading account. Here is how to manage your trade and place your stop loss. For a long position, you place your stop loss 5 to 10 pips below the outside day candle. So you can put it 5 to 10 pips below this area. In case of a bullish or a bearish trade, you put it 5 to 10 pips above the area. Let's not forget our take profit target. We should target at least 1:2 risk to reward ratio. Our profit target should be, if we are risking 1% of our account, our profit target should be at least 2% of our account. So if we are risking 1%, we should get 2% in profit. Or we can decide to use a trailing stop, as the case may be. Before entering a trade, ensure that these conditions are met. First, the outside day appears in direction of the larger trend. Why we enter this trade is because the outside day was in the trend of the market, which is the bullish trend. The same with this, we entered because it was in the trend, the bearish trend of this market. Second, the second thing we need, the second condition that needs to be met is the volume. The volume is an average, the volume is above average during this pattern formation. Let's not forget that the volume indicator should not be low as this. It needs to be above average, and this volume is showing yes, there is really volume in the market. The volume is spiking towards the upside, showing that there is a strong volume or there is a strong pressure in the market. The third condition that needs to be met is no major news or economical news events scheduled during the period of our trading. Before we enter, we have to make sure there is no major economic news event. As you can see, we traded in an area that we did not see any signs of news events. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and share. Turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and we'll see you in the next video.